Okay, so good evening, class. We will be discussing on the subtopic of top level analysis, which would focus on the preparation of your pro forma financial statements. So basically, again, this would still be part of the long discussion on budgeting, and it's just that we have finally reached the final step of the budgeting process or the last step before the budget cycle will start anew. Okay, so if we go back to the flow for the master budget, of course, everything starts with the vision mission of the company as to the goals of the company, which we would then convert into a strategic plan. And based on the strategic plan, the activities of the company in terms of capital projects and operating activities would be developed. Okay, obviously, your capital projects would deal with the uh, longer term activities, okay, activities that would span more than one reporting period, while your operating objectives would revolve around your day-to-day activities, your operations for a particular uh, year. Okay, and from these activities, from these operating activities and capital projects, you would of course develop your uh, capital budgets and your operational budgets, which would which we have already discussed before. Okay, and closely related to them would be your financial budgets, which would essentially be leading you to the preparation of your pro forma financial statements. So your uh, pro forma financial statements uh, would be composed of the three that is being shown here: your pro forma income statement, your pro forma balance sheet, and your pro forma statement of cash flows. So from your operational budget, we'll be able to prepare our pro forma income statement. And from the income that we will be able to determine, we would be able to finalize the equity section uh, of our pro forma balance sheet, and also as to the inventories, receivables, payables. It would also lead up to the preparation of your pro forma balance sheet. Okay, and of course, your capital projects would also contribute to the different line items of your pro forma balance sheet, and everything would be finalized, would be tied up together by the preparation of your pro forma statement of cash flows. Okay, so when we're talking about your operational budget, that would involve your sales budget, which has been discussed already, your purchase budget, your production budget, and your selling administrative budgets. And then when we talk about financial budgets, again, that would involve your cash budget, which is highly related to your pro forma statement of cash flows, and of course, your financial budgets would lead up to the preparation of your other pro forma financial statements. So basically, we've gone full circle already from discussing different strategic tools, okay, different tools in developing strategic plans, then the preparation of the various budgets. We have now come to the preparation of your pro forma financial statements, which is uh, put under the topic of top level analysis. So basically, the questions on top level analysis would revolve around figures that would be presented in your pro forma income statement. Okay. You will not expect that you would be asked to prepare an entire balance sheet, an income statement, or a statement of cash flow. Normally, the questions in the examination would revolve around uh, questions on the amount that would be reported on any of those financial statements. Okay, and that's why the practice questions given to you would do that, just that, which is to test whether you can uh, determine or arrive at an amount that would normally be presented in your pro forma financial statements. Okay, so this would lead us now to the uh, practice questions for pro forma financial statements. By the way, after the discussion on these practice questions, I'll be giving you also the answers to the practice questions uh, on wrapping up your operating budget. As I've mentioned in the previous discussion, the best thing to do here is to simply answer as many questions as possible to test whether your logic in answering these kind of questions are correct. Okay, so basically these additional practice questions would still be related to your operating budget, which again includes your operation cost and even part of your uh, production cost. So basically, additional practice questions for you to master the topic on the topic and problems on budgeting. And afterwards, I also give you pointers as to the possible essay questions that will come out in your upcoming examination. Okay, so but let's answer first the practice questions on uh, pro forma financial statements. So, of course, as always, I would want you to read the question first. For number one, the question here is, what would be the cash flow from operating activities on the company's 20XA pro forma statement of cash flows? Okay, so what would be the cash flow from operating activities? So, one thing that is being tested here is your knowledge on the composition of or the accounts that would help you arrive at the cash flows derived from operating activities. Okay, so here you can start at the uh, net income. This is what we do if we are using the indirect method. So if we go over the problem, the company's actual 20x7 balance sheet and pro forma 20x8 balance sheet are below. In addition, pro forma net income is projected to be 700. Depreciation expense is expected to be 100 in 20x8. No debt will be repaid in 20x8 and no stock will be issued in 20x8. Okay, so based on this information, how much would be our cash flow from operating activities? Okay, so basically the pro forma statement of cash flows is already given. We are just asked to use the pro forma financial statements to answer or to figure out additional information that is not expressly stated in the financial statements. Okay, so again, this would be one way of being tested on this topic, especially that this is categorized under top level analysis. So there will be problems wherein you will already be given with the uh, pro forma financial statements, and you will just be asked to make use of these pro forma financial statements to provide information which would be used in decision making on the part of the management. So here we're given with the pro forma statement of cash flows, and we are simply asked based on this pro forma statement of cash flows how much will be the cash flow from operating activities. And at this point, this should not be a new topic to you because even in the discussion and statement of cash flows, you have been uh, tested on your knowledge on determining the cash flows that will come from operating, investing, and financing cash flows. Okay, and as discussed before, if we're talking about operating activities, the focus here would be on your current assets and your current liabilities. And here we can start with our net income. Okay, because based on this information, the method that we can use would be the indirect method. Okay, so we would start with our net income, which is the 700. And we already know that in computing for your operating activities, you would be adding back your depreciation expense, because depreciation expense reduces your income, but it does not have any effect on your cash flow because it is a non-cash expense. So depreciation expense would be added back, and then the changes in your current assets and your current liabilities would be uh, reflected. Okay, so at this point, you should know that increases in operating current assets are treated as outflows, and increases in operating current liabilities are treated as inflows. Okay, so starting with our 700, we will add back the 100 depreciation expense. And if we look at your accounts receivable, what happened to our accounts receivable? It increased. So meaning uh, we were able to generate more revenue, but out of our revenue, uh, more remained in our accounts receivable instead of being converted or realized into cash. So our revenues in the budgeted year, uh, more of it goes to our receivable instead of being collected into cash. Okay, uh, so this would be deducted from our net income. So the increase in our accounts receivable again would be deducted from our net income. And then for your inventory, what happened to the inventory? Again, it also increased. Okay, so again, increase in current assets would be treated as a deduction under the indirect method. So we'll also deduct the 400. We will not include the uh, we will not include the change in our fixed assets because it will not form part of our operating cash flows. If it's a long-term asset, if it's a fixed asset, it would go to your investing cash flows. Okay, next, go to your current liabilities. What happened to your current liabilities? It increased. And again, what will happen if your current liabilities will increase? It would be treated as an additional source of cash flow, because accounts payable basically represents expenditures, which can be in the form of purchases or other expenses. So that means if your accounts payable increase, that means more of your expenses remained unpaid. So you have this level of expenses, but you did not use uh, that amount of cash to pay off these expenses. So if we're looking for cash flows, you will have to add it back from your net income. So you add the increase in your accounts payable. And then other accruals, what happened? It increased by 200, the same treatment for accounts payable. So this would be added to our net income. So then ignore the long-term debt and equity because those will go to your financing activities. So with our net income of 700, we add back the depreciation expense of 100. We deduct the increases in our accounts receivable of inventory in the amount of 200 and 400. And then we add the increases in our accounts payable and our other accruals in the amount of 600 and 200. That would give us 800, 600, 200, 800, 1000. That would give us an inflow of 1000. Okay. Uh, so again, increases in current assets, deduction from your net income in solving for your cash flow. So of course, the opposite would also be true. If your current assets decrease, then that would be added back to your net income in solving for your cash flow. For your liabilities, increases would be added to your net income to solve for your cash flow. The opposite would be true. If your current liabilities decrease, they would be deducted from your net income to solve for your operating cash flow. Okay. So, and this topic should not be new to you. We've been solving a lot of statement of cash flows problems from the very beginning. Number two, the company is this similar to the earlier problem? Yes, but let's just check the question. Maybe the question is changed. Net income is still 700, and then depreciation expense is still 100. No debt will be repaid, and no stock will be issued based on this. What would be the cash flow from investing? So basically the same problem, but this time you're asked for investing. And if the question is on investing, our focus would be on our long-term assets. Okay. So here the investing activities would come from our net fixed assets, and here the net fixed assets is expected based on the actual and the pro forma financial statement. The fixed assets are expected to increase by uh, 600, from 4,000 to 4,600. Okay, but one thing to be careful of lang, that the increase in your fixed assets uh, includes the 100 decrease due to depreciation expense. Okay, so basically the change in your net fixed assets would be explained by the amount of depreciation and the amount of any purchases of additional fixed assets. Okay, so what is the question here? What would be the cash flow from uh, investing activities on the company 20x8 pro forma statement of cash flows? So here, if your fixed assets increased by 600 even after a decrease of 100 due to depreciation expense, that means the total increase in your fixed assets due to acquisition must be 700. Okay, and the reason why your fixed assets would increase by 700 is because of your additional acquisition. Okay, and uh, that would mean that the cash flow, the amount of cash flow from investing activities would not just be the 600, but instead it would be the 700. So basically, you started with 4,000, and then if you want to check whether your answer is correct, uh, 4,000 at the start of the year, and then you added 700 additional investments in fixed assets. Okay, but by the end of the year, it would be reduced by the book value will be reduced by 100, representing the depreciation expense. So your ending balance would be 600. Okay, so the answer here would be letter B, 700 outflow. Okay, again, if your net fixed assets will increase, your long-term assets will increase, that would mean that you have cash outflow from investing, used in investing activities. Okay, so the answer number two again would be Bravo. Number three is a different problem now. The company's balance sheet is below. Let's read the question first. What is the ending balance for common equity on the company's pro forma balance sheet? Uh, what is the ending balance? What is this? In the one given now is the 20x7. So this is now an example wherein we would be the one to develop or to come up with the pro forma financial statements for the budgeted year. So what's given here is the balance sheet for our base year of let's say 2007. Okay, so the problem tells us that sales in 2007 were 500,000, and then expected to be 560 in 2008. In addition, net income is expected to be 56,000 in 2008, assuming cash, accounts receivable, net fixed assets, accounts payable remain the same percentage of sales in 2008 as 2007, and long-term debt is the same in 2008 as 2007. What is the ending balance? Okay, so basically, uh, we will have to convert this into a common size financial statements and follow the instruction given in the problem as regards the relationship of your balance sheet accounts to your sales. Okay, so the important information here is that it says that all these accounts will be the same percentage of sales in 2008 as in 2007. So uh, we must determine first how much is the percentage of these assets and liabilities in relation to the sales in 2007. Okay, so cash in 2007 is 25,000. Okay, and the problem tells us that the sales in 2007 were 500,000. So 25,000 divided by 500,000, that would mean cash was 5% of sales. And why is the 5% important here? Because we will use the same rate or percentage to determine the amount of cash in 2008. Okay, and do we expect the amount of cash to be different? The answer is yes. Even though the percentage will remain the same, we will expect the cash to be different because the sales in 2008 is already uh, different. Okay, and then uh, if we continue, this would be accounts receivable would be 60,000 divided by 500,000. 60 divided by 500, that would give us 12%. So that means accounts receivable is 12% of sales, and the inventory is 100,000. 100,000 divided by 500,000, that's easily 20%. Next, net fixed asset would be 200,000. So 200,000 divided by 500,000, that would be 40%. Okay, and if we proceed with accounts payable would be 30,000. 30,000 divided by 500,000, that would be 6%. And then our other accruals would be 40,000. 40,000 divided by 500,000, that would be 8%. Now, if we use these percentages for our pro forma 2008 balance sheet, that would mean our cash would be still 5%, but this time 5% of 560. Okay, so definitely you will need calculators here. So 560 times 5%, our cash for the pro forma balance sheet would be 28,000. Okay, and then for your accounts receivable, the percentage was 12%. So if you multiply 12% by 560, that will give you 67,200. So your accounts receivable now would be 67,200. And then inventory will be 20% of 560. That would be 112,000. And then net fixed assets, it would be 40%. 40% of 560. The 560 is the net income for 2008. That would be 224,000, which will just be double our inventory. Okay. And then if we continue, we'll have our accounts payable, which is 6%. 6% of 560. We would have 33,600. And then for our other accruals, which is 8%, 8% times 560, that would be 44,800. Alternative solution class would be to get the percentage increase in your sales. Okay, so since your sales is 560 this for the budgeted year, and last year it was 500. So if you divide 560 by 50, that will give you 112%. So that means there is an increase of 12%. So you can actually just multiply all the figures by 112%. So for example, our cash is 25, we multiply it by 1.12. That would still give us the same uh, amount we've solved earlier. Okay, so either you do what we did early first, or you just multiply the amounts given in the base year by 112%, representing the increase, since they are just a fixed percentage of your sales, and our sales increased by 12%. Okay, now, based on all those things, our cash is 28,000, our accounts receivable is 67,200, our inventory is 112,000, and our net fixed assets is 224,000. Our pro forma total assets would be 431,200. Okay, and that is important because we know, based on the basic accounting equation, that assets would be equal to your liabilities and equity. And here we are trying to solve for our equity. So we knowing our total assets would help, because that would uh, help us work back on our equity. So long as we can correctly compute for our liability. Okay. Now our total liabilities. What happened here? We know that our accounts payable now would be 33,600, and our other accruals would be 44,800. What will happen to our long-term debt? What does the problem tell us? The problem tells us that long-term debt will remain the same, so it will just be 50. Okay, and then knowing that our liabilities would be 33,600, 44,800, and 50,000. This would give us a total liabilities of 128,400. Okay, and if we already know our total liabilities and we also know our total assets, we would already be able to solve for our ending equity. Okay, so we'll just have to deduct our total liabilities of 128,400 from our total assets of 431,200. So this would mean that our ending equity would be 302,800. So the answer here would be letter A. Hopefully, it would not take this long to answer each problem as we move forward. Okay, this number 4 is a shorter problem. Number 4, the company had an accounts receivable balance of 21,500 on its December 31, 24 balance sheet. Cash receipts for 2025 show uncollected credit sales of 25,000 at the end of 20x5. Aspen is also budgeting 1 million of credit sales in 2005. What was the uh, accounts receivable balance on the December 31, 20 X5? Okay, this is a very straightforward problem, class, and you might think that it's more complicated than it actually is. Uh, since we are asked for the accounts receivable balance that will be shown in the balance sheet, so basically it's just the amount of credit sales that have not yet been collected. So here it already tells us that the cash receipts for 20x5 show uncollected credit sales of 25,000 at the end of 20x5, and that would already be the ending balance of our accounts receivable. Okay, so the answer number 4 would simply be letter C. Number 5, question is, what is Cheddar's anticipated ending cash balance? Let's try to read the problem. The company is preparing its cash budget for August. At the beginning of the month, the cafe expects to have 17,500 in total available cash. What month is this? Beginning of August, 17,500. Over the course of the month, it expects to make 12,250 in cash disbursements and obtain 3,750. What is Cheddar's anticipated ending cash balance. So this should not be difficult to solve. We have a beginning balance of 17,500 and we will have disbursements of 12,250. So obviously that would be a reduction. And then we will obtain financing. So that would be an additional source of cash. So that would be an addition. So this would be 17,500 minus 12,250. And then and then add the 3,750. That would mean our ending balance is 9,000. So the answer here would be letter D. Okay, number 6 uh, is this very similar to number 4. Uh, the sales here instead of 500 it's 600 and from 600 it increased to 654. In the earlier problem the 500 increased to 560. Let's see the percentage change here. 654 divided by 600, that is 1.09. So there's only a 9% increase. Okay, but let's see what is being asked. So the question here is similar to number 4. What is the common equity? Okay, everything is the same. Remain the same percentage of sales. Long-term debt is the same. So basically the same procedure. And since we've already discussed it in number 4, let's try to do the quicker way. We know that our total assets would just be the same percentage of our sales, and we know that our sales increased by again 9%. So to determine our pro forma total assets, we'll just multiply the 444 given here by 109% to account the percentage increase. So that would be 483,960. Okay, 483,000 960. Okay, and then, but of course, you can be asked as to the amount of cash, accounts receivable, inventory, net fixed assets in the pro forma balance sheets. But again, we're trying to solve this quicker since we have already discussed this in detail in number 4. Okay, then we can also do the same for our accounts payable and our other accruals. Okay, since they remain the same percentage of our sales, it's just that the sales this time has increased, which would lead to an increased amount of accounts payable and other accruals. So we can just add the 42,000 accounts payable and 54,000 other accruals, multiply it by 109%. That will give us 104,000, 640. Then since just like in problem number 4, long-term debt remained the same, so we'll just add long-term debt at 40,000. So that would mean our total liabilities is 144,640. And then deduct that from the pro forma total assets we have computed earlier of how much? 400 83,960. That would mean the balance of our equity for the budgeted year would be 339,320. So the answer here would be letter A. Um, Number 7. Let's go to the question first. If a strategic goal for the company is to improve its ability to pay interest expense, does the 20x8 pro forma income statement indicate it will achieve this goal? So here, one very important uh, knowledge is being tested, whether or not you know how to solve for your times interest earned ratio, okay, or your interest coverage ratio. And hopefully this has been discussed already in your financial statement analysis. So here you're given with your actual and your pro forma financial statements, and you're just asked whether your times interest earned ratio has improved. And to be able to answer that, you should also know what is a good or improving times interest earned ratio is if your times interest earned ratio increase, does it mean it improve or not? Okay, so at this point, hopefully you already know that if that it's good for you to have a high times interest earned ratio. So here, if we'll be able to determine that our times interest earned ratio has increased, that would mean that we have actually improved our times interest earned. Okay, or our ability to pay interest expense. So the next thing here that we have to know is to how to compute our times interest earned ratio. Okay, so basically everything is given here. The challenge really is just for you to remember the formula for your times interest earned ratio. And the formula for your times interest earned ratio is your operating income divided by your interest expense. Okay, very straightforward, class. Your times interest earned ratio is the ratio that would tell you the number of times that your net income can sorry your operating income can cover your interest expense. So that's why it's better if you have a high times interest earned ratio. Okay, but the challenge here is that students would get confused. What would be the numerator for my times interest earned ratio? Will it be my operating income or your net income? Again, it should be your operating income. And basically, everything that you need to solve for your times interest earned ratio is already given. It's just a matter of remembering what are the two things you need to solve for your times interest earned ratio. Again, this would be very important. Okay, make sure to remember that your times interest earned ratio is equal to your operating income divided by your interest expense. And in this case, solve first for 2007 for us to have a base uh, information. So 60,000 divided by 8. Uh, 60,000 divided by 8, that will give you 7.5. And then for the 20x8, it's 84,500 divided by 84,500 divided by 10,000. 8.45. So uh, that means our times interest earned ratio increased, which is a sign that it has improved. So our answer here would be either B, C, or D. Let's check. Yes, because the times interest earned ratio is expected to increase from 7.5 to 8.5, which is exactly what we have solved. So letter B would be the correct answer. Okay, letter C is incorrect because just because your operating income increase doesn't mean that your times interest earned ratio will also increase. And even if your sales are expected to increase, it does not automatically follow that your times interest earned ratio will also improve. Again, the answer here is letter B. Number 8, the CFO of the company wants to evaluate whether accounts receivable as a percentage of total assets is expected to increase over the previous year. What report or statement should be used for this purpose? So if you're looking for the percentage of your accounts receivable in relation to your total assets, you would need your total assets and your accounts receivable. And where can you find your total assets and your accounts receivable balance? Obviously, in your pro forma balance sheet. So the answer here, number 8, would be Bravo. Number 9, what's the question here? Still operating. Let's just skip number 9. The answer here would be letter A, 1,300 inflow. Make sure to solve this in your own. Find time to solve number 9. Okay. Number 10, question here is use the percentage of sales method to calculate pro forma net income. Okay. So the 2007 income statement is below. Sales in 2008 are expected to increase by 5%, assuming cost of sales and selling and administrative expenses remain the same percentage of sales in 2008 as 2007. Interest expense is the same in 2008 as 2007, and tax expense remains the same percentage of earnings before taxes. what is the pro forma net income. Okay, so here uh, our sales is expected to increase by 5%, and we cannot just multiply 99,000 the net income in 2007 by 105% because the changes in the other components of the net income did not change uh, in at the same rate. Okay, so we really have to do this step by step. Okay, first for your cost of sales, we know that your cost of sales is 220 in 2007 and your sales was 4,000. So your percentage of sales 220 divided by 400. Your cost ratio is 55%, so that would mean your gross margin is 45%. You can check that by dividing 180 by 400, so that means your gross margin is 45%. Okay, so if we know that our sales will increase by 5%, you multiply 400 by 105%. That would mean your sales now would be 420. Knowing that our gross profit rate is 45%, you can just multiply 420 by 45%. Uh, this would skip the process of having to solve for our cost of sales. Okay, so our adjusted cost of sales, our projected cost of sales would now be 189,000. But actually, there's a simpler way of solving the 189,000. Since the change in your cost of sales and sales would just be the same, that means the rate of change for your gross profit would also be the same. And we know that the rate of change is 5%. You can just multiply the gross margin of 180 by 105%. That would still lead you to 189. Now let's check what happened to our uh, selling and administrative expenses, the same percentage. Okay, our selling and administrative expenses is 40,000 divided by 400. That would mean our selling and administrative expenses was 10% of sales. We know that our projected sales is how much was it? 400 times 105%, 420. So 420 times 10%, our projected selling and administrative expenses is 42. We were able to compute earlier that our projected gross profit is 189. If we deduct our selling and administrative expenses of 42, this will give us 147. But again, there's actually a shorter way of doing this. Since the changes here is just the same rate of change in our sales, we can immediately go to our operating income of 140 and multiply it by 105%. That will still give us 147. And then what did it tell us about interest expense? Interest expense is the same. So 147 minus the same interest expense of 8. That will give you 139. So please remember the 139. Next would be your earnings before taxes is 132. And then your tax expense now would be the same rate. Okay. Your tax expense was 33 and divided by earnings before taxes of 132. That means your tax rate is 25%. Okay. So we'll use that also. So again, 147 of projected operating income minus 8,000 interest expense. That would mean our earnings before taxes is uh, 139,000. Since we know that our tax rate is 25%, the complement of 25%, which would represent our net income, is 75%. So we can just multiply the 139,000 by the 75%. So this would mean our net income, our projected net income would be 104,250. So it's a long way of solving this, but it's just a matter of following the instructions given in the problem. So the answer here would be letter A, 104,250. Let's skip number 11 also. The answer in number 11 would be letter D, 400,000 outflow. Okay, make sure to find time to answer number 11. Number 12, which phrase best describes uh, a pro forma statement of cash flow, evaluating whether inventory as a percentage of assets would increase. No, that would be shown in your pro forma balance sheet. Evaluating whether cash flow targets will be met. That could be true. Let's just check the other answers. Evaluating whether debt to equity ratio. No, again, that's in the balance sheet. Evaluating whether gross profit as a percentage of sales is expected to increase. No, that would be in your projected pro forma income statement. So the best answer here is letter B. Number 13, the question here is what amount will be reported for accounts payable in the March balance sheet? Okay, let's check what's this all about. The company is preparing the budget for the first quarter and estimates that budgeted cash purchases will be 106,098,400 and 103,600. The company also purchases on credit and historically pays 40% of its credit purchases in the month of purchase, 50% in the following month, and 10% in the second month after the purchase. Credit purchases during this time is 186,007, so on and so forth. What amount will be reported as accounts payable in the March? Okay, so basically by the end of March, you would need to check what purchases would still remain unpaid by the end of March? Do you still have January purchases that are unpaid by the end of March? Do you still have February purchases that are still unpaid by the end of March? Do you still have March purchases that are still unpaid by the end of March? You add all those unpaid amounts, then that would be the balance of your accounts payable. Okay. And to determine how much of your purchases, your monthly purchases, is still unpaid by the end of March, you will have to take into account the uh, payment policy of the company. Let's check. Uh, the company will pay 40% on the month of purchase, 50% in the following purchase, and 10% in the second month after the purchase. So that means after 2 months from the purchase, then the purchase will already be fully paid. So that means your January purchase class is already fully paid by the end of March because your January purchase, 40% of it will be paid in January, 50% of it will be paid in February, and the remaining 10% will be paid in March. So at the end of March, none of your January purchases is still unpaid. Okay, so our answer will not include any amount from January. For February, 40% of our February purchase would be paid in February. 50% of our February purchase will be paid in March. So at the end of March, only the remaining 10% remains unpaid. So in our answer, only 10% of February would be included. For your March purchase, by March, only 40% of it would be paid, while the remaining 60% will be paid in the next 2 months. 50% of it is in April, and 10% of it would be in uh, May. But definitely by the end of March, 60% of our March purchases would still be unpaid. So knowing that, since our purchase in February is 98,400, and we know that the portion that is still unpaid by the end of March is just 10%, so in our answer, it would include 9,840 from the February purchases. And then you add the 60% from your March purchases, so 60% times 103,600, that would give you 62,160. And then, uh, what's this? Oh no. The amounts that we mentioned were your cash purchases. Of course, we should be focusing on our credit purchases. Okay. So, uh, for February, it's 174,800, and we know that only 10% of this would be unpaid by the end of uh, March. So we'll have 17,480. And then your 202,000 March purchases, we know that by the end of March, 60% of it would still be unpaid. So that would be 121,200. We add the 10% of our 174,800. That would give us 138,680. So the answer there would be letter D. Next, number 14. What's the question? Determine the balance of accounts payable on B's budgeted balance sheet of December 31, 20x5. Let's see if this is any different. The company's cash payment budget for 20x5 indicates that all of B's direct materials are purchased on account. B's payment history indicates that it pays 70% of its purchases in the quarter of the purchase and 30% in the following quarter. Purchases for the fourth quarter of 20x5 were 50,000. Determine the balance of accounts payable on B's budgeted balance sheet of December 20x5. 70% is paid in the quarter of purchase. The remaining 30% is paid in the following quarter. So we do not have to concern ourselves with the third quarter purchases because 70% of our third quarter purchases will be paid in the third quarter, and the remaining 30% will be paid in the next quarter, which is in the fourth quarter. So meaning all of our third quarter purchases are already paid by the end of the year. So we'll just focus on the fourth quarter purchases, and we know that 70% of it is already paid. So the remaining amount that is still unpaid by the end of the year will just be 30% of our fourth quarter purchases. So you multiply 30% by the amount of your fourth quarter purchases, you would have 30% times 50,000. That would give you 15,000. So the answer here is simply letter C. Number 15. Okay, another form of problem. Uh, we are asked, this is also a common type of problem. If the beginning cash balance is forecasted at 30,000, how much will the company need to borrow from the bank to meet the minimum required balance of 30,000? Okay. At the start, we have 38, but it's possible that it may go down below 30 based on the disbursements that we will make. So, in that case, we'll have to make additional borrowings for us to meet the requirement of 30,000 minimum balance. So the company has completed its budget for all cash receipts and disbursements for the first 6 months. The company's bank requires a monthly minimum balance of 30,000 and offers the company short-term financing. For April, the company has cash receipts of 18 and cash disbursements of 62. So, the problem is not even complicated. The amount of disbursements and inflows or receipts are already given. So if we start at 38 and then we have receipts of 18, add the 18, and then we have disbursements of 62, that would mean we would have a negative balance of 6,000. But we must maintain a balance of 30, so that means you will have to make uh, borrowing of not just 30,000, but you have to borrow additional 36,000 just so that your balance would be 30,000 by the end of the period. So the answer number 15 would be 36,000. Number 16, a very similar type of problem. We will skip this one. The answer number 16 would be letter A. Okay, and then number 17. What amount would be reported for accounts receivable? Okay, let's check the manner of collection. The controller has determined that the company collects its credit sales in the following pattern: 40% the month of sale, 50% the month following the sale, and 10% in the second month after the sale. What amount will be reported? Okay, what month are we in? So we are in March. Okay, let's check for our January. When do we achieve complete collection? 50% in the year of sale. So that would be in January, in the month of sale, 10% in February. Sorry, 40% in the month of sale, 50% in the month following, so that would be February, and the remaining 10% in the second month of the sale. So our accounts receivable by the end of March would not include any amount from our January credit sales because by the end of March, the entirety of the January credit sales is already expected to be fully collected. For February, it's different. Our February purchase for sales, credit sales, 40% of that is collected in February. 50% of that would be collected by March. So by the end of March, the portion that is uncollected is only 10%. This is very similar to the earlier problem we have solved, but in the earlier problem, it was an accounts payable. This time it's an accounts receivable. For our March, the portion that is collected here will just be the 40% in the month of sales. So 60% of this would still be unpaid by, uncollected by the end of March. So 575 times 60%, that would be 345. And then 10% of 510, that would be 51. So this would be 396,000. I hope you're not having any difficulty here. It's just a matter of following the instructions in the problem. Okay. Number 18, I think this is still this times interest earned. This is no, this is something new. Okay. Uh, so here we are trying to check if we have improved in our efficiency in producing the goods. So here one way of assessing your efficiency in producing your goods will be the percentage of your cost of sales in relation to your sales. If you'll be able to reduce your cost of goods, then that would mean that you're able to efficiently produce your goods. So here, let's compute for uh, cost of our cost ratio and check if it has improved. Okay, so in 20x7, the cost of sales is 340 and the sales is 500. That would mean your cost ratio was 68%. And then in the pro forma income statement, your cost now is at 357,500 divided by your sales of 550. That would mean that your cost ratio is now at 65%. So your cost ratio actually went down. So you can actually say that you were able to improve the efficiency of your production. So our answer here would be any of the yeses here. Letter A would now be the answer because it gives us the amounts that we have solved. Uh, uh, that's expected to decrease from 68% to 65%. Uh, what do you call this? Your profit ratio is not the better tool for assessing production efficiency because again your net income already takes into account other expenses not related to production. So again the best answer here is letter A. Number 19, the CFO of the company must evaluate whether operating income of the upcoming year is likely to meet expectations. So if your focus is on operating income, you should be looking at your pro forma income statement. So the answer here is letter A. Number 20, I think this is a similar problem. Let's skip this one. The answer here would be letter A, 31,500. Next, number 21. Uh, which phrase best describes the use of a pro forma balance sheet? Evaluating whether profitability targets will be met. No, that will be more on the income statement. Evaluating whether cash flow targets will be met. No, that would be in your pro forma statement of cash flows. Evaluating whether the debt to equity ratio is expected to increase over last year. Of course, you can see your debt and your equity in your balance sheet. So this would be a likely answer. Number letter D. Evaluating whether gross profit. No, gross profit as a percentage of sales would be shown in your pro forma income statement. So the answer here is letter C. Okay. Number 22. I think similar. Let's skip number 22. The answer here is again letter A, 45,750. Uh, Number 23 is a different kind of problem now. Let's answer this one. The question is, how will CAF's debt change in 20x8? Okay. Uh, this time there will now be a change in our 20x in our projected balance sheet. In the other problems, our long-term debt has remained the same, which now would be a problem because we are now trying to look how much will be the change in our long-term debt. Let's see. Uh, Sales is 900 and expected to be 972. Net income was 81. Into 27 is expected to be 88. And then CAF paid out 60% of its net income in dividends in 20x7 and plans to do that again in 20x8. So that would tell us the changes in our equity. CAF does not plan to issue any new equity in 20x8. Okay, okay, okay. So we can still do the shortcut for our total assets. How much is the increase in our sales? It was 900. Now it is 972. So 972 divided by 900, that means there's an 8% increase. And since our all our assets are the same percentage to our sales, so the total assets will also be the same percentage to our sales. So all we can simply multiply the total assets by the percentage of increase uh, in our sales. So we can just multiply. How much was it? 972 divided by 900. This gives us 108. This tells us that our sales increased by 8%. So we multiply 693 by 108%. That will give us 748,440. Okay, and then uh, next, the same also would be true for our accounts payable and our other accruals. That's 72. Let's add them first. 72 plus 99. That would mean we will have 171. Multiply that by 108%. That would give us 184,000. 184,600. Okay. Next would be our common equity. The problem tells us that our uh, what does it tell us? Uh, what will affect our equity would be our issuances of shares and payment of dividends and our profit. Okay, but we will not be issuing additional shares. But what we have here is our profit, and our profit is how much in 20x8? 88. But not the entire 88 would remain our equity because we will be paying it out as dividends also, some of it, which specifically 60%. So if you multiply your 88 by 60%, that would mean that you will be paying out 52,800. Okay. Actually, it's better for us to use the 40%. So multiply 80,000 by 40%. That means the amount that will remain in equity would be 35,200. And then add the add the beginning balance for equity of 442. That will give us 477,200. And then if we add the projected balances for our accounts payable and our other accruals, that will give us a total of 661,880. And this is the amount that we would deduct from our projected total sales of 748,440. So 748,440 minus the combined projected accounts payable, other accruals, and common equity of 661,880. That would give us 748,440 minus 661,880. That would give us 86,560. And since the beginning long-term debt was 80,000, that means additional borrowings were made in the amount of 6,560. So the answer in number 23 would be letter A. 24, which of the following is least likely to impact the cash needs of a company? Collection patterns, obviously, it will have an impact. Payment patterns, the same. Capital expenditures, also the same. Write-offs for obsolete inventory does not involve your cash, so the answer here would be letter D. Number 25, uh, calculate the pro formas after tax profit for next year based on the data shown here. Uh, so sales now would be if you notice the change in your sales and variable costs are the same because of course uh, your variable cost is variable. So I can just immediately go to our gross profit. Uh, it's actually called contribution margin. Uh, anyway, 100 minus 60 and then multiply it by 110%. 40 times 1.1, that would be 44. And then deduct salaries of 15 plus, how much is 105% of 15? 15 times 1.05, that's 15,750. And then other expenses increase by 20%. So 20% of 5,000 is 1, so that will be 6. So 15,750 plus 6 will give you 21,750. Deduct that from your projected contribution margin of 44,000. That will give you 22,250. And then if your tax rate is 30%, your profit now would be 70% of that. That would give us 15,575. So the answer number 25 is 15,575. 26. Let's skip number 26. I think we've solved a similar problem already. The answer is letter A, 184,800. Number 27. Uh, okay, I think we've answered a similar problem already. 27 would be letter A as well, 59,100. Number 28 times interest earned ratio also, and the answer is also letter B. Hopefully, this comes out. The choices will be shuffled. The answer here is 28. In number 28 is letter B. Make sure to find time to solve for the times interest earned ratio. Again, the formula is operating income divided by interest expense. Number 29. Uh, the change. Okay, I think we've solved a similar problem already. The answer here is letter A, 26,000 will be repaid. I think the scenario here is that your liability, long-term debt will decrease. Will have to decrease to make the accounting equation balanced. Okay, in the earlier problem, it was additional borrowings, but this time the long-term debt must have decreased. That's why the conclusion here is that there will be repayment of 26,000. Number 30, uh, you'll be working. Okay, let's just solve this one. What are we looking for? If the budgeted sales price per unit is 120, what is the budgeted income from operations? Okay, so sales and gross profit. You have your cost of goods sold in your sales. That would help you compute for your gross profit. So 1620 minus 1188. Your gross profit is 432,000. Deduct your selling and administrative expenses of what? 324. That would give you income from operations of 108,000, and that's already the question. Income from operations, so that is 108,000. That's it. If this comes out, it's as good as a bonus question. Number 30 is 108,000. Number 31, let's see. Uh, Let me get charger first. Number 31, let's try to do the same. What is the question? Budgeted income from operations still? How, how could this be any different? 1944 minus 1425.6. That's 518,400 minus 388.8. That would give you 129,600. And that's the answer already. Answer 31 is 129,600. These kind of questions is an insult to your intelligence class. 32. Answer is still letter A. 4,120 will be borrowed. Find time to answer these problems again. 33. I think we have similar problem already. This time from financing. Okay, let's try to answer this since this is asking for financing. If we're talking about financing, we'll be talking about long-term debt. Okay, what happened to your long-term debt? No debt will be repaid and no stock will be issued. Okay, so our long-term debt increased by uh, 100, so we'll have additional cash flow from financing. Common equity also increased um, by 400, but we will have to check. Maybe some of the changes here is due to our net income. Okay, what does the problem say? Net income is projected to be 700. Okay, so there's an increase of 400 and we have a profit of 700, and normally if you have a profit of 700 you can expect that would result in an increase in your equity, the amount of 700, but here the increase in your equity is only uh, from 29 to 30 is only 400. So there must be something else that that was offset against the increase of 700 for it to only increase by 400. So there must be a decrease of 300. A possible explanation here would be perhaps payment of dividends, which would fall under your cash flow from uh, cash outflow from financing. So from your long-term debt, you will have an inflow of 100, but from your equity, you will have a cash outflow of 300. So the net effect would be a 200,000 outflow. So the answer here is letter D. 33 is letter D. 34 skip. Answer here is 97,500. 35 again skip. Answer here is letter B. 600,000 outflow. Again, find time to answer these problems. 36. 36 is 24,000. 24,000, let's see. Has a beginning cash balance of 21. During the year, the company expects cash disbursements of 17 and cash receipts of 145. If the target cash balance is 20, how much must be borrowed? So you have 21, then you will have receipts of 145, but you will have disbursements of 170. So you will have actually negative 4, but you want your balance to be 20. So that means you will have to borrow 24,000 for your ending balance to be 20,000. 37. What's the question here? Uh, okay, still on collection. You can figure this out, class. 37, the answer is 5,400. 38, which of the following action is least likely to impact the cash needs of the company? Least likely, so will not affect cash needs. A company decides to sell on credit rather than selling for cash only. So you will have lesser cash if you decide to sell on credit, so that would have an effect or an impact on your cash needs. A company decides to offer customers a discount for paying payables within 10 days. That would have an impact also on your cash needs because you would be receiving your payables but at a lower amount. Okay. The company decides to increase production capacity by 15%. Possible, but not really. Let's just try to compare with the other choice. A company decides to recognize an impairment loss on a piece of equipment. Out of all these choices, this is the one that has the least impact on your cash needs. So the answer here is letter D. Number 39, what amount will on this budgeted balance sheet for accounts receivable at the end of the quarter? Uh, this is an easy question. The answer here is 1,440,000. The answer here is letter B, which is just 50% of 2,880,000. Next, number 40. Uh, what's the question here? Improve overall uh, efficiency. If we're now talking about overall efficiency, the best tool to use here is the percentage of your net income in relation to your sales. Okay. Uh, so here, your net income in 20x7 is 39,000, and then your sales is 39,000 divided by 500 is 7.8%, and then in the pro forma income statement, it's 55,875. divided by 550,000. That would be 10.16% or 10.2%. The answer here would be letter B. So again, if uh, a production efficiency, it would be your cost ratio. If overall efficiency, it would be your uh, net profit ratio, your net income over your sales. So the answer here in number 40 would be letter B. Number 41, this is new question. For the month of January, it projects the following selling and receiving expenses: sales commission of 4% of sales, shipping expense 4,500, advertising and marketing costs payable next month, and then of 12,000, electric and water utilities 750, corporate office depreciation for computers and budget expense. Sales for the month of January equals 400. What are the total expenses that will be reported? This should not be difficult, class. Let's see. For your sales commission, obviously this will be part of your expenses. You multiply 4% by 400, that give you 16. And then shipping expenses of 4.5. Next, for your advertising and marketing costs, you should know by now that we follow accrual. So even if it is payable next month, that would still be reported as an expense this period. So that would the 12,000 here would be included. Electric and water utilities of 750. Depreciation, even if it's non-cash, would still also be included. That's 88. Budget expense also 8,000. So this will give you 50,050, and that is the answer in number 41, letter C. Number 42. Uh, what's the question in number 42? What are the total expenses? Against this is similar. Find time to solve this. Answer number 42 is letter D, 96,120. Number 43, I think this is just a similar problem to ones we discussed already. The answer here is letter A, 162,000. 44, ending cash balance. This should not be difficult. The answer here is had 150 in total available cash. Financing needs total 12, and cash disbursements were 50. Ending balance for July, so 150, 160. Sorry. Financing needs total and cash disbursements were 50. What is Laura's ending cash balance? Um, so you know that your available cash is 150 and your expected cash disbursements is 50, and then you had required financing of 12. So you had 150 available, you used the 50 of 100, but considering that you still needed additional financing of 12, that means your ending balance must be 112,000. Answer number 44 is letter C. Number 45, skip. Answer is letter A. 12,720 will be repaid. Number 46, which phrase this best describes a use of a pro forma income statement? Profitability targets will be met. That can be supplied by the pro forma income statement. Cash flow targets, more on the statement of cash flows. Liquidity ratio, more on your balance sheet. Changes in your debt, also in your balance sheet. So the answer here is letter A. Number 47 is again overall efficiency. So you use net income over sales. The answer in number 47 would be letter B. Number 48, answer is letter A, 2,600 will be borrowed in 20x8. 49, What's the question here? Based on this, how much in dividends is the company forecasting to pay? So first, your equity. Total assets is 460, total liabilities is 260, so your equity would be 200. How much profit do we have? Net income is expected to be 50. So you had equity at the start of 180, you have profit of 50, that should give you 230, but our ending equity would only be 200, so there's a deduction of 30, and that must represent your dividend. So the answer here is letter A, 30,000. Number 50, what report or statement should be used for this purpose? What are you looking for? Cash flow from operating. So obviously the pro forma statement of cash flows. Uh, Number 51, answer is letter B, 53,400. And number 52, the answer is letter A, 2,400,000. Okay. So make sure to find time to answer the problems we have skipped. This time, I'll give you the answers to the additional practice questions on wrapping up the operating budget. Okay, number one, answer here is the fourth choice, 39,605 increase. Number two, uh, it's letter C, freight out, selling and administrative expenses. If you'll notice, the type of questions here are very similar to the ones we discussed uh, previously. Number three, answer is letter B, 350,400. Number four, answer is letter A, 321,750. Number five, answer there is letter D, budgeted sales in units, selling and administrative expense budget. Number six, 225,000. Number seven, third choice, they are incorporated into the unit cost that is used to calculate the cost of goods sold for the income statement. Number eight, a pro forma income statement. Number nine, 2,900,000. Number 10, fourth choice, a decrease in variable administrative expenses per unit and a decrease in variable manufacturing expense per unit will both increase the contribution margin per unit. Okay, I think this will come out. Make sure to remember this one. Next, number 11, answer is the fourth choice. The traditional cost of goods sold formula begins with direct materials purchases, so on and so forth. Again, the answer is this one, the fourth choice. Number 12, answer is 544,625. Number 13, 1,000,000 361,575. And then number 14, very long problem. Answer is 62,000. Number 15, the first choice, advertising expense, selling and administrative expense budget. Number 16, uh, maybe one of these problems will come out, long problems will come out. Answer is 1,000. Number 17, 1,296,263. Number 18, 3,900,000. Number 19, 270. Number 20 is the third choice, the production line manager. Number 21 is 1,600,000. Number 22, 1,071,000. Number 23, 964,200. Number 24, the third choice, components of an operating budget include the sales budget, cost of goods sold budget, and selling and administrative budget. This can be asked as a uh, essay question. What are the components of an operating budget? And then number 25 is maintenance expense, manufacturing overhead budget. Number 26, 806,400. That's it. Now let me give you some pointers in preparation of the essay questions. For your exam, you will have two uh, scenarios, and I think each caselet will have four sub questions. One caselet will be for RCMA one, and the other caselet will be for RCMA two. So basically, I'll be giving four questions for your essay, and that would be half already of your essay examination. Let me just pull up the uh, test map. Okay, and out of those four questions, class, two would be computational, and then uh, two would be objective. It could be definition, it could be enumeration, it could be comparison, you'll be asked to differentiate, so on and so forth. Okay, or again, you can just be asked to enumerate. For financial statements, if this would be an objective question, you could be asked what are the three kinds of cash flows and define each. This would be your investing, your financing, and your operating cash flow. Make sure you know how to define them. And then for your recognition and measurement, for computational, you could be asked to solve for the balance of your investments. You could be asked for the balance of your accounts receivable, the net realizable value of your receivable. The same could also be asked for your inventories and your PPE. For objective questions, you might be asked to explain the impairment testing process for your property, plant, and equipment, again, which we have discussed before. Okay, remember the two steps of impairment. What else? For recognition and yeah, maybe that's it. For planning, budgeting, and forecasting, of course, for your strategic planning and your budgeting concepts. For your strategic planning, remember your uh, PESTEL, your SWOT analysis, your BCG growth share matrix, your Boston Consulting Group growth share matrix, your SMART objectives for a successful strategic plan. What does the SMART stand for? Uh, for budgeting, you might be asked to compare the different kinds of budget, your zero based budgeting, your activity based budgeting. You make sure to be ready with the definition of the different kinds of budgeting. We might be asked to simply uh, lay out the budgeting process. Okay. For budgeting, I don't expect you to be asked a computational there. If there would be, it would be very easy. It would be very uh, logical. Okay. Then for your top level planning and analysis, you might be asked to prepare a pro forma, but basically the same as what we discussed just moments ago. You'll be given a base year and you'll be given information as to how the projected financial statements will look like. For your technology and analytics, you have a lot of terminologies there. You might be asked to give definition of different terminologies. Just be ready with the terminologies. Or you could be asked for the COSO internal control framework. What are their different components of the COSO internal control framework? So make sure to be ready with that one. So basically, a lot of definition. If there will be an essay question out of your technology and analytics topic. Okay, so hopefully you'll do good in your uh, uh, pre-final exams. For additional pointers in the essay, you can go back to the discussion I shared to you for the budgeting pointers.